Now let's look at ratios that managers would use to assess profitability. This will be looking at earnings and earnings potential. And what managers need to do is to try to look at the profitability of the company through the eyes of an investor, because investors want to know that the company is using their investment to generate a profit. All right, from your lecture notes, you need to reference the balance sheet and the income statement of Aggie Inc. We'll be calculating these ratios for 20x2. The first one we'll look at is gross margin percentage. And this is just the percentage of sales that remain after the cost of inventory is covered. So the formula is gross margin over sales. Another name for gross margin is gross profit. If you look at the income statement of Aggie Inc., you can see that the gross margin is $52,000. Sales are $95,000. So when we plug in 52,000 divided by 95,000, we get 54.74%. So this tells a manager that about 55% of sales remained after inventory costs were covered. Of course, the other side of that is that 45% of sales went toward inventory. Now we can look at what happened last year, what is common for our industry, to see if we're controlling inventory costs. Next, we'll look at the net margin percentage, and this is looking at what percentage of sales are left after all expenses are paid. So this is a measure of just general cost control. The formula is net income divided by sales. If you look at the income statement of Aggie Inc., you will see that net income was $8,000 while sales were $95,000. So plugging in 8,000 divided by 95,000 is 8.42%. Now this tells a manager that 8.42% of sales remained after the costs were covered. So if about 8% went toward profit, 92% went toward expenses for inventory and every other expense that the company had on the income statement. All right, the next couple will look at how management used what was available to them to earn a return. So the first one, return on total assets, this measures how did management use the assets to generate profit. The formula is net income plus interest expense times 1 minus the tax rate over average total assets. So what we're doing here is we're adding interest expense back on an after-tax basis. The idea behind that is that if you had no assets, then you should have no interest expense. So we don't want income to be diluted by interest expense. So we add it back. All right, so when you look at your income statement, that's where you'll get your numerator. 8,000 is income. We'll add back interest expense of 2,000, but we'll do this on an after-tax basis. So we'll have to see that tax rate of 20%, and we'll take 1 minus 20%. So the numerator looks like this. 8,000 of income plus interest expense of 2,000 times 1 minus the tax rate, or 1 minus 0.2. Now we'll take a look at our denominator, which is average total assets. 93,000 at the end of the year, 86,000 at the beginning of the year. And so when we plug that into the denominator, on average, let's see, the numerator calculates out to be 9,600. Average assets are 89,500. And that gives us a return on assets of 10.73%. So management used the assets of the company to earn a return of almost 11% this year. Now remember, management's going to use the assets again next year to earn another return. We also want to take a look at return on equity. This just looks at how did management use the stockholders' investment to generate profit. So the formula is net income over average stockholders' equity. Now in this calculation, we're just looking at all equity. We're not going to break it down by various classes of stock. So we will go to our income statement, and for the numerator, all we need is the income of $8,000. For the denominator, we're going to need to go and look at the equity section of the balance sheet. Now what you see here is that the dividing line for liabilities and equities is right there between bonds payable and common stock. So your equity accounts for Aggie Inc. are common stock, additional paid-in capital, and retained earnings. So if you add those up at the end of the year, it's $52,000. At the beginning of the year, it was $48,000. So we'll put that into our denominator. 52,000 plus 48,000 divided by 2. So we have average equity of $50,000 for the year. We have income of $8,000 for the year. And that gives us return on equity of 16%. So this will tell managers that they used the common shareholders' investment to earn a return of 16% during 20X2. So that's a look at profitability ratios. If you'll notice when you look back over those formulas, they all relate to the income statement and are looking at relationships of income to various things.